Welcome back to the Kenshin Funeral Homes website. We appreciate you coming in, and today we're going to be talking about insurance. What is insurance, how insurance works, different types of insurances, and we'll even talk about pre-need. So we'll begin with a pre-need, and then I'll introduce the guest next to me. All right, so pre-need, for those of you who might not know, is where you sit down with the funeral director and you map out your funeral plans. You pick the casket, you pick the day and time of service, you pick the church, you pick the music, you pick the clothing, you set up your funeral prior to. Now, some people choose to pay for it prior to, and some people choose to just have the information on file. So a true pre-need is usually paid for through an insurance product or an annuity. So you can either do a 10-year pay on the total cost of the service, or you can do a single pay, or you can do the annuity. If you are really sick and you can't get any insurance of any sort, then with the annuity, you put dollar in, you get dollar out plus interest. So we try to accommodate you in the way necessary, and so to give you as much information as possible so that you can make the best choice for you. So now, to my right, is Mr. Joshua Thomas, who is a master's in financial planning, who is many years in the insurance game, who has a wealth of knowledge that you will find helpful in terms of you making decisions with regard to insurance. So
Thank you for having me, man. I appreciate it. It's an honor.
it's my pleasure.
Yeah, good.
I have a great deal of respect for you.
The feeling has been cool.
All right. So let's start by what is insurance?
All right. So life insurance specifically, because sometimes people get those things confused, right? They think insurance on their car, insurance on their house, and then they'll say insurance in their life, and they'll kind of mesh it all together. Those are two completely different types of insurances. So life insurance is going to be a death benefit on a specific insured, right? It's going to be on a person's life. There's many components to the life insurance policy. I'll try not to get too technically boring because I don't want to pay anybody that doesn't know, right? But generally, there's going to be an owner, there's going to be an insured, and there's going to be a beneficiary.
And who is an owner?
The owner can be someone with insurable interest, meaning a business partner, a family member. Generally, in this sense, we'd be talking about family members here, right?
So I could take an insurance policy out from you and be the owner, and you're the insured, and I could be the owner and the beneficiary.
Oh, yeah.
But you would have to have knowledge of my doing that.
You'd have to have knowledge and you'd have to lose something. Insurable interest would mean you can't go up to a stranger, right? I can't go to a random person and say, hey, let me put some life insurance on you, because I don't lose anything if that stranger passes away. But if it's a husband, if it's a wife, if it's a child, if it's a mom or dad or a business partner, generally that's going to be insurable interest. So it's illegal to take insurance out on a stranger. Sometimes people will kind of do that. Sometimes people try to go and, go up to the, people on the side of the road. The unhoused is the politically correct term, right? Yeah. And say, hey, let's put a life insurance. That's highly illegal. You have to lose something by it, but obviously sometimes your mom or dad, they may not be able to afford the insurance. So what happens then? You can take out the policy, you can own it. And here's what's important. If you're paying for a policy, you should own it. Because if you do not own the policy, and this was this is a terrible story. I got 30 seconds to tell it. This lady, she was not my client, bought a policy on mom, and mom was the owner. She was the beneficiary. Since mom was the owner, mom got a new boyfriend. Daughter had been paying on this policy for 12 years, and 8 months before she passed away, she got a new boyfriend. When the daughter showed up to the funeral home to place what's called an assignment of this policy, mom had switched the beneficiary to the boyfriend, and the boyfriend was nowhere to be found. He never even came to the funeral, and the family had to do a GoFundMe. So it's important that you own any policy that you're paying for, because if you're not the owner, then the other owner could change the beneficiary, and you'd be surprised how many times that happens. So
No, I wouldn't.
okay. This is true. Yeah, you've seen it all. Yeah, So you've seen it all. And generally, when people think life insurance, they think death insurance.
Right.
Okay.
But it doesn't have to be. Just because you name somebody the beneficiary of a policy doesn't mean that they're going to use that policy for your funeral rate. It's not ingrained in the law that says whatever, that money becomes that person's money, and they can choose to do it or choose not to do it.
So you obviously run Kenshin Funeral Home, and all the time when somebody brings in the life insurance policy, there's something that you're going to verify. You're going to call the insurance company and you're going to verify a date of issue, right?
Right.
Why do you do that?
Because anything 2 years or under is in what they call a contestable period, meaning that the insurance company has the right to review your insurability. So they can choose to not pay the premium, even when they say, oh, it's a guaranteed issue. Guaranteed issue only means they guarantee to give you a piece of paper that's almost a marriage. And you go, so for the same, I'm not trying to talk about anybody's company or anything, but
Right.
people need to understand that just because this is a guaranteed issue does not mean they're guaranteeing to pay unless when you list out all of your issues, the company exception, with all those issues, and you die with one of those issues or all of those issues.
So to give some clarification, sometimes people get upset at funeral directors. Sometimes people get upset at life insurance brokers or agents. When you buy the policy, from day one, the date of issue, to 24 months later, if you die, if you pass away, even on a day one coverage policy, they're going to pay you, right, as long as you didn't lie and you didn't commit insurance fraud on the application, but they're going to investigate. So during that investigation, it's going to take 4 weeks up. I've seen it take as long as 6 months.
Sometimes a year.
Right, for homicides and things of that sort. And so it depends on how the person passed away. But in the interim, generally people are going to need money to bury somebody within 2 weeks. So the family can be upset and disgruntled because they don't understand. They're like, man, those doggone insurance companies, and they don't say doggone, right? Those insurance companies don't want to pay, but the truth is that there's a protocol in that period of contestability because there's a suicide clause in there. They need to make sure the person didn't commit suicide. If you commit a felonious act, so if somebody's robbing a bank, they're not going to pay that death benefit, right? If somebody overdoses, they'd be on drugs
2 years.
right? Within that first 2 years, they are not required to pay. So it's important that obviously we want insurance companies to stay solvent, but people understand that period of contestability. So if you do lose someone, the first thing you need to look at you need to find the policy. Now, once you know who's interruption.
Sure. The first thing you need to do is find an agent like Josh who will sit down with you and take the time to explain it all to you, rather than just, you want $10,000, it'll go for $20, give it hit. Because then you don't understand what's going on.
Sure.
And then you need to have somebody else present with you to hear what's being said. So when you're not able to respond, or you've died, or you're sick and incapacitated, they'll understand as well what is happening with this policy. I'm sorry.
No, not at all. So when people, obviously the worst has happened now. Are we talking about people passing away? Now they're kitchen funeral home. They walk through the door and you say, well, did mom have a policy? Did dad have the policy? How often do you hear, I don't know? Often, right? That happens. So the first thing is that if you have a life insurance policy, you don't need to stick it under your mattress. Your children or whoever your beneficiary is needs to, number one, know the policy, know the amount, know the company, and hopefully they have the document, right? Either via email or the physical document. Give it to them, because if you're gone, right, then what good is it for you to have that policy? Second, Eric, how do you guys locate the policy? So they're here, mom died, and they're trying to locate it. What do you do?
There's no central place to look. Sure. Now, you can call the insurance commissioner's office, but that might take months before they can maybe find it.
Correct.
If it's filed. Sure. Because I don't think there's a regulation that forces an insurance company to file. So what happens is people just start rummaging through their mother or father's things, trying to find it. That's it. Now, if you've retired from a place, then that might be where your insurance policy is. And so you call a place of employment, form of employment, and you get the information that you need from them. That's good.
I got one more trick. If you have access to mom or dad's bank statements, you go and look for insurance companies. Look for something that ends in insurance company or mutual. You can also look at where mom or dad was insured their car, because sometimes through State Farm or Allstate, people may have gotten it that way. So that's something, to look into.
And then that's something that's, if you will, just started, because a lot of insurance companies are moving to the direct payment as opposed to somebody knocking at the door.
Sure.
But for the really older people in the community, they may still be door collected. And in that case, now you're looking for receipts.
Okay.
If they're ready, to try to figure out, to figure out what's what.
So all right, you got me started. So is your mother or grandmother agent? is knocking on their door in 2024 to collect their premiums, can tell you this: they're most likely overpaying, right? And there is no physical way for the beneficiaries to know if mom or dad paid. So our grandmother or grandfather paid. So if they're knocking on your door, they could say, oh, well, she didn't pay her policy, for the last 2 months. You have nothing to dispute because, yeah, some of them give you an envelope, and yeah, some of them are honest, but those are called debit companies. And debit companies have the highest turnover of any agents in up until 2023. A lot of them weren't licensed. Legally, they were not licensed. I know dozens of them. And they're just studying for their license now. Still some good agents. I know some great people that work for debit companies. But the companies themselves, some of them, not all, but there's some toxic cultures, there of sometimes if grandmother giving somebody who's not honest, not ethical, cash money, and it doesn't make it back to the officer. Who's to say, right, that grandmother paid or didn't pay?
So, they're supposed to give you, a lot of times they'll write on this card that they'll initial the date that they collected the money and how did they collect it. And they'll also issue a paper receipt. But again, but by and large, I find that a lot of the debit companies that are still out there, the larger ones for sure, have a lot of honesty.
Good people. So, they have some great people. What I'm saying is a worst case scenario and things I've actually seen, right? So, and I'm not calling a specific company out of it. I'm saying by large that I'm going to err on the side of caution.
Right.
The EFT, some people say, well, why does it have to come out of my bank account? Why do they have to draft? Some people hate the D word, right? The draft. Oh my God, don't draft my account. Listen, that is protection for you, right? It's protection for you in the event that you go to the hospital, in the event that you get Alzheimer's or dementia, you forget to write a check, or the person never comes and knocks on your door to collect the cash. It's imperative that you have that EFT. And look, most credible companies are going to really mandate the EFT in this nowadays. Yes, to where your bank writes the check.
Even the smaller companies, the debit companies, some of them have gone to EFTs. They won't let you pay at the door. Sure. And again, it's for your protection. It is. And then if something happens, you don't know where the policy is, like you were saying earlier. That's one way you can look and you can see the insurance company's name in some cases. And so you know that the policy is paid.
And you go and lastly, you say, well, what if I don't have a bank account? Well, how can I, have an EFT if I don't have a bank account? Because some people who are getting Social Security, the Department of Treasury fixed that problem. They issued them direct express cards. They're little green cards that are, they're issued by MasterCard. And we've got two companies I know that we work with. We work with dozens of life insurance companies as brokers. We've got two companies where it can come right off the direct express card on whatever day, and it'll be Social Security billing. So if it's on the last Wednesday, the 28th or the 3rd or the 1st.
And some companies, if you have a debit card, some companies will take it off your debit card. Sure, it's another EFT guy thing. You give a date, and they'll take it out from your debit card, and that's it. You have to have the money on your card. That's it. You know how y'all do.
That's it.
Rich people go out, get all that money on the weekend, and then when it's time to pay your insurance, if you like it,
yeah, they went on a cruise, they turned it off. So we keep saying life insurance, right? We keep saying life insurance, and I've already differentiated between car insurance and house insurance and cell phone insurance, and obviously the insurance gets a bad rap at times. But life insurance, 100% of the time, you're going to need it because 100% of people pass away. The question is that does your policy do what you needed to do when you needed to do it, right?
Right.
What's the good policy? There are arguments of term insurance versus whole life insurance versus universal life insurance. And what are those different types? What have you seen as far as, I guess, a cautionary tale? Because, have you seen any cautionary tales as far as people having the wrong type of insurance?
Yes, and thankfully it's before somebody passes. Please God. But once it was after somebody passed, and they didn't realize that the term had expired. And term, we're talking about term. Term could be term to 65, term to 100. Term could be 10 years. Term could be 20 years. Term could be 30 years. But it means at the end of that time, the end of 30 years, if you're not dead, then you don't have any insurance. And then what happens is, 30 years from now, you're 65 and now instead of insurance costing you $50, excuse me, $50 for $75,000, $100,000 worth of insurance, it's not going to cost you $300 or $400 or $15,000 or $20,000, $25,000 worth of insurance. So it's important if what you're doing is trying to protect your family in the event of your death, timely or untimely, and if what you're doing is trying to make sure that the funeral expenses are covered and there's a little change afterwards, then you have to decide the type, if you want term, the type of term insurance you're going to get, or if you do whole life or universal life, sure, index funds or what have you that Josh mentioned.
Sure. To cut in on you, when people ask me all the time, what's the best type of life insurance, right? What's the best type? Well, it depends. I'll rebuttal that by saying, what's better, car insurance or house insurance? All right, that depends on whether or not you get in a car accident or if there's a hurricane coming on, right? The truth is that they have different places they do different things. So is term good? What is term for? Term is going to terminate. You say, well, somebody buy that. Short term is no cash value. Well, if you have a 30-year mortgage and you have a 30-year term, that's perfectly fine. If you have young children, right, and you want to make sure that your kids go to college, in 30 years, your children are going to be grown. If you have debt, if you're trying to do income replacement, for instance, if your wife doesn't work or if your husband doesn't work, and you want to make sure if you pass away in the next 10, 20, 30 years, that your income is replaced, term is that's the policy for you. But the truth is that people have temporary and permanent needs. And as they age, then the term piece goes away because a lot of times they can't get medically insured for that. And I'll talk about the underwriting in a second.
But the thing though, the other thing with term is, if you're a person who can save, then that also works. But if you're a person that does not save, or you have trouble saving, or you have minimal income, and the chances of your income going up from year to year is minimal, or it goes up slightly, 1-2%, then you might not want to look at a term policy. You might want to look at a whole life policy, the different types of whole life policies. The thing about insurance is, the younger you are, the cheaper it is. And so if you're in your 20s, or me in my 20s, I would probably do some kind of index fund or a whole life policy of some sort, because even though I don't need $1,000 at that point, I will at some point. And if I get it while I'm young, then it costs me much of that.
Most people need both. If you're under 55, you've got a spouse, you've got bills, you've got people who depend on your income. Most people need a mix. Once you're 60 and over, generally you're going to be leaning just straight directly whole life. But to give you that breakdown, honestly, like when I will talk to people about Index Universal Life, they don't know what that is, right? It's acronym for IUL, and it's a way to blend really the stock market, if you will, the S&P 500 specifically, and to take your cash value and put the cash value off aside and invest it inside of an index fund. And as you pay on the policy, they're very complex, and I do a 30-minute presentation on it.
Right, but it's still a great way to save. 100%. It's a force save.
100%. And then there's something else. We can tax diversify your retirement income with that. How we do that is that it's flexible premium. So if the premium is $50 for the insurance, what happens is we'll put $250 a month into it. Where's that cash going? It's going to the index fund. So in 20, 30, 40 years, or let's just say 15 years, if you've got $50,000, $80,000, $150,000, you can take a loan from your cash value. Well, the IRS, and if you're a Googler, right, the IRS Rule 7702 is going to talk about you putting more money into a permanent life insurance policy, specifically an IUL. So you can overfund it with the purpose of pulling it out via loan, but the IRS can't tax a loan. You would be surprised what happens.
How very delivering though, when you put the money in, it's already taxed.
That's a fact. Yeah, that's a fact. But we live in a nation that has taxation without representation.
Well, that's not going to change.
You know, our brain is.
Yeah, well, doesn't matter who's president. That's not.
So when we look at the tax diversification, that strategy is specifically to pull money out later. But when we talk about a permanent life insurance, generally that's going to be with the purpose of burial an inheritance. Some people want to leave a legacy to their kids. You know, they say, look, when my mama passed away or when my dad passed away, all he left us was a loan.
Right.
Right, to pull the old school song, right?
Right.
But I want to leave something for my kids. And as you can see with the cost of everything going up, talking about cost, do people ever come in here with $1,000 policy or $2,000 policy?
Not much anymore.
Right.
But the other thing is about the death benefit for insurance is it's not taxable. If you invested in something, then the interest from that becomes taxable. But the money itself is not taxable, so you don't have to report it.
Correct. The death benefit.
The death benefit.
And you can access the cash value via policy loan on that tax loophole, and it's tax free.
Yeah, but if you got a $10,000 policy, please don't do that.
No, and that's another thing.
Yeah, everybody.
You see it, right?
Yes.
People walking in with a $10,000 policy, and they took a $4,000 loan from it because it had cash value. Listen, if this is a burial policy, do not take a loan on it. I cancel this before I do that and buy it.
But you don't even have to cancel it, because what happens is the cash value that's in the policy then is used to pay for the policy.
Yep.
So if you just leave it there, it'll continue to pay. Might be, you have to look at the table, might be a year, might be 5 years, might be 10 years, might be 15 years. But so if you decide, say you have one of the debit companies and you want to go with a whole life company for a larger amount, just leave that there. So that won't be a reduced paid up, it'll still be face value. There's a reduced paid up that you can do.
I get what you're saying.
But the cash value will continue to pay for the face value of that policy. So what happens is for at least 2 years in one day, while you're waiting to make sure that you have any problems with this new $100,000 policy that you just bought from cash, then you know you have this 10 or 15 or this 20 over here.
Certainly.
So that money is then used to pay for the new policy and whatever additional amounts. Sure. So I think that's really important, that you don't listen to the agent and, just cash it in. Don't cash it out.
Yeah, there's something called what he's describing is called a non-forfeiture option.
Right.
There's reduced paid up. There's different things that you can do to protect.
But the other thing is when you're filling out the policy, make sure the agent doesn't mark loan to pay for the policy, because you're not paying for the policy. You're hurting yourself.
Right.
Because you're reducing the face value of that policy.
Correct. That's it. So like if you had $4,000 of cash, you had a $20,000 policy. What he's saying is that they can make you an offer for $10,000 if you don't pay it anymore, but you leave the $4,000 there. What he's saying is we get the new policy and you use the cash to pay the $80 a month or $60 a month for those 2 years. Once you're clear the period of contestability, and I feel like we're doing too much. I feel like somebody. Yeah, I feel like it's TMI. Yeah, it might be TMI.
Yeah.
Obviously, we're passionate about it because we see what happens when it goes bad.
Right.
People think that I'm a salesperson, right? They think until something happens. There's two questions when somebody dies. The first is how did it happen? The second is who's he or she insured with. They need to know, because immediately there's a bill that represents, right? Now you guys will pick up bodies from the hospital, correct?
Right. From the place of death.
From wherever they die. It could be the house, it can be wherever.
Right.
That's a transportation fee, right?
Right.
So the bill starts, once you pass away and you close your eyes, the bill starts, right? For somebody to move that body, and when you move it past state lines, there's more money that's involved, right?
Right.
So, it's obviously things that people don't think about. Now, as far as the things I've seen, as far as like one would be inflation protection. If I talk to somebody who's in their 20s, 30s, or 40s, they'll say right now the average cost of burial is a full service from top to bottom.
It depends on what you're talking about. If you're talking about a funeral service, then it's around $5,700. If you're talking about a funeral service with a burial, depending on the cemetery, it could cost you $12,000 for the minimum.
Right. That's going to be the national average right now. It's $12,000.
Well, that national average probably
15. Yeah, 15 is right. Yeah, you're right.
Yeah.
It's probably.
We're not that expensive, but other people are. Depending on where you are, it could jack the price up even more.
Sure.
Because services can be as much as $20,000.
Sure.
If you for some larger funerals, the minimum or the beginning might be $10,000 for a casket service. And then if you pick a cemetery that's another $5,000 to $10,000, depending on where you do them, mausoleum or grad at work or whatever, you're talking $20,000.
Some people want either a horse and buggy and doves and and fire breathers, and you just never know. Some people do it big,
Right.
And that's something to be discussed.
Right, because you don't realize how fast the costs go up until you're in it. And then with us, we'll cash advance the items. And so then when you really sit down and look at what you spend, you go, did I really spend that much money? Yeah. Not here at the funeral home.
Sure. Yeah.
But outside this funeral home, you spend more money than we spend on the funeral.
What's the average on flowers? I saw a number recently.
$500-600.
Right. So up to $1,500 depending on what you want, right?
Depending on what the kind of flowers you want, and if you want just a casket piece, or if you want 2 stands or 1 stand, or that kind of thing.
Yeah.
And so those things are. But the thing that has, I guess, has shocked me more than anything else in the industry is the cost of cemeteries. You know, the cemetery, you can start at $4,200 and go up, because by the time you put the vault, by the time you put the headstone, so talking $6,000-7,000. Some cemeteries might start around $5,000-6,000, but it's all inclusive.
Sure.
You know, so with meaning that it's the grave, it's the vault, it's the headstone, etc.
Off the top of your head, 20 years ago, so now we're at 12,000. 20 years ago, were we at
Probably about half of that.
about 5 or 6, right?
6, 7.
So we can assume that
Yeah,
it's doubling
Yeah, it's gonna.
again in 20 years. So why are we saying that? Because sometimes when I'm sitting in front of people who are 20, 30, 40, 50, so the average American female dies at 78 years old. The average American male dies at 76 years old. So we're doing a mathematical equation, right? With an inflation adjustment whenever we make a recommendation for just the burial policy.
Right.
Sometimes people will think, oh, you're in sales. Well, no, I'm advising you. Because sometimes Melba and Pawpaw would have bought a $1,500 policy, and then 20 years ago when they died, it was $6,000. They're trying to figure out, why would they buy such a low policy?
Because the time they bought it, it was a lot of money.
It wasn't inflation adjusted.
Yeah.
So you have to think about inflation. In 1999, when I was in high school and I was a senior, gas was 99 cents a gallon. It was over $3 a gallon, right? It's tripled in 20 years. You don't know whether, there's different charts. If you want to assume 3%, 4%, 5%, it just depends. But the gist is, by the time you pass away, it's going to cost more now.
Right.
For somebody in their 30s or 40s, you need a $50,000 burial policy.
At least.
You need $50,000, right? That's just for burial. So when we begin to make recommendations, we don't make numbers up. We do what's called a financial needs analysis. And what I'm trying to figure out is what's permanent, right? How much do you want to leave your kids? And that number, you don't have to leave your kids anything. You can leave your kids with pictures, right? Do that. That's it. Put a picture on the wall. I love
They
it.
don't leave them anything.
Right. Right?
Hard assets. So
Right. That may not be important to you, but for some people, they're trying to figure out how can they leave the biggest legacy. And here's a little trick, and I don't want to go too long. If you're 20, 30, 40, or 50, there is the Index Universal Life policy, but it does something that no other policy does. It gives you an option on the death benefit. You can do what's called a level death benefit. So if you bought a $100,000 policy, you pay it for 30 years. In 30 years, you pass away, you got $100,000. You've got a lot of cash value in there, but it's still $100,000. But you can do an increasing death benefit. For all young people, right, who want to leave a legacy, I recommend this policy, because what it does is the cash value in this policy gets what's called paid up additions. So as you're paying for your premiums, it's buying more death benefit. So if you're 30 and healthy and you die at 80, your $100,000 policy could accrue up to $500,000. It's the most inexpensive way to really leave a large legacy that outpaces inflation and grows with inflation.
and also go back to the flexibility. It also is a place where you stash your money, if you will, but it's legal.
Certainly, yeah.
Where if something comes up, college tuition, house burns down, something unforeseen happens, there's a stash of money that you can then access tax-free as a loan that'll help you get through a rough period.
Sure.
So that policy really is one to think about. Let's put it that way, because I'm not saying that's what you should do, but
Right. Right.
because the recommendation, as Josh has said.
You don't buy life insurance with money. I want to touch on that. I know we're almost done, but people will come to me and they'll say, man, I want $1 million policy. I want this. And money's no object. But then they have something in their, in their medical history that's going to limit the amount of insurance we can get them for. Every insurance company has what's called an underwriting department. So we're going to ask you at least 10 to 15 questions about your health, about your pre-existing conditions. The reason I left, I worked for a phenomenal company in New York Life. New York Life is a great company, but they're one company. To become a broker means you represent multiple companies, because some people will have COPD. Some people have extremely high blood pressure. Some people are insulin diabetics. Some people are going to have kidney issues and so on and so forth. So depending how we pair you with a specific company, it's not just about what's cheapest, because what's cheapest is an accidental death policy that only covers you if you die accidentally.
And people don't realize that.
Have you seen those?
Yes.
Walk in the door?
Yes. Yes. When they have a $25,000 accidental death policy, and I have to look at them and say, this only pays in the event of a common carrier. You're on the bus, you're on the plane, you're on the train, there's an accident, you die as a result of that, that it pays.
Yep.
Other than that, it's just these. And the banks like to sell you these accidental, or whoever it is that with the bank.
Credit union,
Yeah, well, like to sell you these things. They send you that in the mail. You can get $25,000 worth of insurance, accidental life insurance, for $12 a month.
Right.
And you say, wow. But no.
You get what you pay for. So when we look at those add-ons and when we're looking at it, the way that we put people in policies is not just what's going to be cheapest, but what's best, right? So we have to think about, do you want a term? Is your need going to end? So if you're looking for a burial policy, and which is a permanent need, my grandmother's 101. If she passes away, I'll pray we got another 20 years with her at least. But when she passes away, she's still going to need to be buried. So that need never disappears. So when you pair a permanent need, leaving an inheritance or burial, with a temporary insurance, you're setting yourself up for failure. Finally, man, having insurance at my job. I hear that, you'd be surprised. Man, I got insurance at my job. So obviously people know if you quit, retire, or get fired.
If you quit or get fired, you don't have insurance at your job.
Okay, right? But there's one story, man, that opened my eyes, and I was some 6 or 7 years into the business. Sit down with the gentleman. We're talking, he wanted a $10,000 policy on his wife. His wife insisted after we got her, $10,000 her whole life, do $10,000 on my husband as well. The gentleman said, look, I have $250,000 of coverage at my job. Man, his wife insisted, and she scared me and him both. So we did what she told us to do. We put $10,000 to get through the application. He told me he had just quit smoking, but the question was 12 months. I told the truth. Right. So you always need to have an agent that, don't wink and, rely on the application, because they can see every time you've gone to the doctor. But if you die under 2 years, they're going to investigate. And sure enough, after we did that, 6 months later, this man was diagnosed with stage 4 lung cancer. He got too sick to work full time, and he'd been in his job for 29 years. They let him go. And when they would let him go, his benefits were gone. So that $250,000 that he was, banking on, when he passed away, guess what policy he had? That $10,000 that his wife made us put on him, right? Thank God for her foresight, and thank God he listened to her. But if you have insurance at your job, that's what I call a lanyard policy. It's just extra. You need to own your own policy, because again, if you get too sick to go to work and so on and so forth, most policies, if you work for, I know some teachers can take like $10,000 maybe with them, but it's very few employers that offer permanent coverage. Yeah.
So if you died, you get sick and you die before you have enough time to retire, you messed up. And then the thing is, you need to know when you retire, if the retirement that you get includes life insurance. That's it. Again, you don't want to wait till you're 65 or 70 years old and you retire to start trying to get life insurance on yourself, because it's so expensive you won't be able to afford it. It might cost you almost $200 a month, or $25,000, $30,000. So while you're young, before you hit your 60s, you need to check out some life insurance.
Yeah.
And again, we talk about term insurance and what that means. And when you're talking to the agent, you need to be able to talk to them about where your needs are, and they should be able to address directly, as Josh says, about your whether that term is best for you. And then you talk about whole life. There are different kinds of whole life policies, and we'll talk about some of those. Again, you need to find an agent who's willing to share with you all of the information so that you can make the best determination as to when that whole life is good for you. I know we've talked about a lot of stuff today, or we've thrown stuff at you, but feel free to call me here at Kenshin and ask me for information. I can give you information. I can give you Josh's number. I can give you some other people's insurance agents' numbers. So it's not like I have a commercial going with Josh. Well, with a wink. But nah, I'm not pushing Josh on you. I'm just saying, and we talked about, under the whole life is the index fund, insurance. And then again, we talked about pre-need. And there are different ways to fund the pre-need. You can, the annuity, regular life insurance, or the 10-year, 55-year, 1 year, 2 year, 3 year, 10-year payment plans, or you can just, if you have a lump sum of cash, you can just put it down on the policy and you're good. So we've given you a lot of information today. You know, again, if you're confused by anything, feel free to give us a call here at Kenshin. I'll give you Josh's number if you call, or Josh can give your number now.
It's 337-298-1023. It's 337-298-1023.
337-235-1193 is the number here at Diffusion. Thank you again. Do you have anything else you want to say, Josh?
Good, man. Thank you for having me, man. I really appreciate it.
It's my pleasure.
Yes,
And broker, you know, Josh said he's a broker, which he kind of said it. So let me just say it again. That means he has a bunch of different policies for a bunch of different companies, which means that he can find the best, a broker can find the best policy to meet your needs. So it might not be with ABC company, it might be with XYZ company, because XYZ might have the same kind of policy with different rates or different requirements. So that ABC company might not take you with high blood pressure, that XYZ company will take you with diabetes and high blood pressure at no additional cost. So that's why you want to deal with a broker if you can, or if you're just in love with a particular company, that's fine too. But a broker can shop around and get you the best price and best rates and the best face amounts too. So again, I want to thank you, Josh.
Thank you, man. Appreciate you. Really appreciate it. Thank you, Dan. It's my pleasure.
Okay. Again, thanks for coming to Kenshin Funeral website. Keep watching. We'll have other stories for you.